everyone, welcome to my YouTube channel. In this particular video, we'll solve one more problem related to income from house property. So they have given that actual rent is 10,000, municipal valuation they have given. Okay. Next, total municipal tax, total is 2,500. In that tax paid by Mr. X, so assessee has paid 1,250. The tenant has paid 1,250. Next, interest paid during previous year on loan taken for renewing the houses. So they are doing the repairs for the houses. So he's doing what do you say, renovation. So for that he has taken certain amount of loan. So that again I have told three deductions. In part one I have told three deduction. First deduction is standard deduction. Second deduction is interest on borrowed capital. So this is a second deduction. Second deduction idu. Next, the repair charges. So one thing you just analyze and remember that in income from house property, when you're calculating any problems in house property, do not consider any expenses. So ignore this repair charges. We will not consider this repair charges. Ignore this. Any expenses, we have to ignore that. Compute our income from house property. So total income we have to compute. So here we are computing the taxable income from house property. So as you are all aware by now, first we will compare municipal rent value with fair rental value. Municipal rental value they have given in the question. It is 8,000. I will write it here. Next, fair rental value they have not given. If they have not given, then we'll consider it to be 0. Out of these two, whichever is higher, we will consider it to be notional rent. So notional rent is 8,000. Now, this notional rent we will compare with standard rental value. So notional rent we have found out it is 8,000. Standard rent, in the question they have not given any details pertaining to standard rent. So standard rent will be 0. So whichever is lesser, so ignore 0. So the remaining amount will be 8,000. That is considered to be lesser. So it is known as reasonable expected rent. Now this reasonable expected rent will be compared with actual rent. So reasonable expected rent we have found out it is 8,000. Now we have to find out actual rent. There is a formula to find out actual rent. It is annual rent minus unrealized rent. Annual rent minus unrealized rent. So in question they have given that actual rent received. Okay, then directly they have given. So annual rent is 10,000 minus unrealized rent is 0. So actual rent received by them is 10,000. Actual rent is 10,000. Out of these two, whichever is higher, that is 10,000, we will consider as GAV before deducting vacancy period loss. Whichever is higher, this is not lesser, whichever is higher, whichever is higher. From that, we will deduct the vacancy period loss. In question, they have not given any vacancy period loss, so it will be considered as 0. So afterwards, we will get gross annual value after deducting vacancy period loss, that is 10,000. From this, we have to reduce the municipal tax paid by the assessee. Only whatever the municipal tax assessee has paid, that has to be considered. So in this question, three types of municipal tax they have given. First one is total municipal tax. In that second thing, whatever they have given is municipal tax given by, paid by assessee, that is Mr. X. Third one, what they have told is municipal tax paid by the tenant. So we will be considering only the municipal tax paid by the assessee. So here Mr. X, okay, he has paid a municipal tax of 2,500, 1,250. Only that one we will be considering. So 1,250 we will be subtracting from 10,000. The remaining amount, whatever is there, that is net annual value. Now for this net annual value, we have to give deductions under section 24. So there are two types of deduction. First one is standard deduction. So standard deduction will be 30% on NAV, 30% on net annual value. So net annual value is 8,750. On that 30% we have to calculate. That will be 2,625. This is the first deduction. The second deduction will be Interest on borrowed capital. Second deduction would be interest on borrowed capital. So interest on borrowed capital they have given directly in the question. So interest paid during the previous year on the loan taken for renewing the houses, it is 500 rupees. So 500 rupees is the interest on borrowed capital. So that also will be given as deduction. So when you add both, you will get the total deductions applicable. So 2625 plus 500 will be 3125. That is the total deductions you will get. So from 8,750, if you deduct 3,135, the remaining amount will be 5,625. That is the taxable income from house property. So this is how you need to calculate when they have asked uh, to calculate the taxable income. You need to even give the deductions. Hope you have understood this video very well. In my next video, I'll come back with some more problems related to income from house property.